Welcome back. You're watching HFO-TV.
So again, please join me in welcoming June Wiyrick Flores.
Thanks, Greg. So I have 15 minutes to cover what's usually an all-day seminar on succession planning. So needless to say, we're not really going to be able to get into it in depth, but I do want to give you some pointers and things to think about. I do have a question, and by show of hands, how many of you have an estate plan? How many of you have a durable power of attorney? Pretty good. That's usually about the number. When you did your estate plan, did you talk specifically about succession planning and who would take over ownership and management of your investments? Big difference. And that's really what the difference is succession planning is looking at, from my perspective, succession planning is looking at not only the change of ownership, but also the change of management. So it can be a little bit more difficult than just doing your estate plan, although I have a lot of clients who have problems doing their estate plan. I actually had a client who has had their trust for 4 years and just signed yesterday, so that was quite an achievement. But one of the things with succession planning requires you to look at your family dynamics. And that can be difficult for clients to talk about whether or not their children should be in business together, which one of them should lead the business. I recommend to clients that you, when you start doing your succession planning, that you pull together your advisors. And really you should have at least 3. One, you need your legal advisor who's going to assist you with the documentation of the plan, whether that's in your estate planning documents or also in your business documents. Then you also should have a financial advisor. And clients are often surprised when I suggest that they have a financial advisor. And part of that is because you need to plan on whether or not you have enough money to transfer the business during your lifetime, or if you need to wait until death. Do you need a liquidation event? Do you need to sell to a third party to be able to maintain your current lifestyle? And then what are the needs of the future generation who are coming into ownership? And then, of course, you need your tax advisor, because in every transaction there is tax issues, whether it's income tax issues or estate tax issues. And I'm going to talk a little bit about the current state of the union with our estate taxes in a bit. So briefly, I do recommend that clients develop a short-term plan. And for those of you who have durable powers of attorney, that was geared towards that question, is that if you have an unexpected life event that impacts your ability to manage the business on a temporary basis, who has the legal authority to access the bank accounts for the business? Who can sign checks? If you have a payroll checks, who can sign those payroll checks? Who has authority to enter into contracts on behalf of the business? Who can sign lease agreements for you? Who can complete the purchase or sale of real estate? Those are key factors. If you become incapacitated, your business documents can have those provisions incorporated in them as to what happens, or if you own the properties in your individual name, then you can do that through the use of a durable power of attorney. And then develop a long-term plan. What if you're permanently incapacitated and you're not going to be able to return, or you're deceased? Who can manage the properties or your investments or your business long-term? What income is needed from those operations to support you during your incapacity, or if you're deceased, to support your spouse and or dependents? And then one of the things that often comes up, and this is probably one of the other people that I'd recommend that you have as part of your advisors, is talking to your banker or your lender. Because if you're going to transfer ownership of the properties, I would assume many of you have properties that are mortgaged. Can the new owners meet the bank's requirements for being an appropriate borrower? And that may be an issue for them. Do they have sufficient collateral? If you're going to divide the properties among multiple persons so that child A gets property A and child B gets property B, with those properties separated, is there still sufficient capital to be able to meet the lending or financing requirements that is needed? So those are just kind of all some factors to think about as you're doing your planning. And then once you have your long-term plan, then you need to have a backup plan to that. Because life happens, things change, and even though you may have a long-term backup plan or a long-term plan, you still need a backup plan to that in case things don't work out the way that you planned them to do. So planning for the estate taxes, this is kind of our state of the union. We have currently, well, let me back up. The estate tax is a transfer tax on everything you own on the day you die. It includes your life insurance policies, which comes as a surprise to many people. It includes your retirement plans, your real estate investments, your cash, your personal property, your art, your jewelry, everything. So think of this as the government's opportunity, the last opportunity to tax you, the taxpayer. There are two levels of estate tax. There is the federal estate tax, and then about 15 states also have a separate estate tax. At the federal level, under current law, we have a permanent unified gift and estate tax. And permanent means that currently the law is not scheduled to terminate or sunset. It would only be changed if Congress and the President sign a new law. Unified gift and estate tax, that means during my life and at death, I can transfer a certain amount that is not subject to gift or estate taxes. If I exceed that amount, then those transfers are subject to gift taxes if I make the transfers during my lifetime, or estate tax if I make the transfer when I die. There's an unlimited marital deduction for transfers between spouses who are U.S. citizens. So I can give my husband $100 million, which he would be very happy about, and there's no estate tax on that transfer as long as he's a U.S. citizen. In addition, there's an exclusion amount, the amount that you can transfer to non-spouse beneficiaries that's not subject to estate tax. Currently, that amount at the federal level is $5,490,000. And it's an odd number because it is subject to inflationary adjustments. So every year it can increase, but it'll never go below what it was in the prior year. The estate tax rate at the federal level is 40%. So it's a hefty tax. At the federal level, we also have a concept called portability, which means that when my spouse dies, if he doesn't use all of his $5.49 million, I get to use what's left of that when I die. It only applies to my last deceased spouse. So if I remarry and my new spouse dies, it's my new spouse's exclusion amount, not my first spouse. And we also have, which is very important, a step up in basis. When you pass away, all of your assets get a step up in basis to fair market value as of date of death. So for example, if I bought property worth $100,000, my basis is $100,000. When I die, that property is worth $1 million. My beneficiary's basis is now $1 million. So if they go to sell that property, they don't have any capital gains tax to pay. That is the law today. President Trump released his tax plan on, I believe it was early April this year. That was a one-page list of policies, which for the estate taxes, he indicated he was going to remove the death taxes. Not a lot of detail in that plan, so planners really don't know what's going to happen. There are a lot of discussions about different ways to address the loss of the revenue from the loss of the estate tax or the estate taxes. And one of those is that we retain the gift tax so that people can't make lifetime transfers. They can only transfer assets at death to avoid taxes or the gift and estate taxes. Another plan is that there would be no federal estate tax, but there would be no step up in basis. This is called carryover basis. So if we go back to that example of I bought property worth $100,000, at my death it's worth $1 million, my beneficiaries wouldn't have to pay estate taxes, but they would receive my basis of $100,000. So when they if they decided to sell that property, they would have to pay gains on $900,000. So even though there may be an elimination of the estate tax, it doesn't mean that it's an elimination of all taxes. It could be an income tax instead. There's also discussions about having a plan very similar to Canada. Canada basically treats it as when you pass away, that you have sold all of your assets. So back to my example of I bought property worth $100,000, it's now worth $1 million. Instead of paying an estate tax, my beneficiaries would pay an income tax on the $900,000 gain between my basis and the value currently. The other issue that's come up as well is that in order to implement a permanent repeal of the estate tax requires the vote of 60 senators. And currently there are not 60 senators who are willing to vote to repeal the estate tax permanently. So instead, Congress and the president may be able to pass what's called a Budget Reconciliation Act, which only is valid for 10 years and sunsets in 10 years. So even though we may have some tax reform this year, it may not be permanent, which means that if there's a change in the administration, in the next elections, we still could have an estate tax. So my clients are asking me, what do I do? Well, you don't stick your head in the sand and ignore it. You still need to plan for all of those other reasons. And we just build in as much flexibility as we can, given that the current state of the federal estate tax is in flux. So remember I said there's 2 levels of estate tax. Not only is there a federal estate tax, there's also a state estate tax. There are about 15 states that have an estate tax. Oregon and Washington are 2 of them. So if you are in Oregon, Oregon has an estate tax. It also allows for the unlimited marital deduction. It does not have portability. So in order to be able to utilize both spouses' exclusion amounts, you need to do the planning. And the Oregon exclusion amount is only $1 million. That law is permanent. So until our state legislature and governor sign a new law, that's what we have. The $1 million is not indexed for inflation, so it stays at that amount. If you are an Oregon resident, then all of your real property and your tangible personal property located in Oregon and your intangible property are subject to Oregon estate tax. Intangible property are things like LLC interests, stocks, bonds, cash, etc. So regardless of whether you have a Delaware LLC or a Nevada LLC, if you're an Oregon resident, those assets are subject to Oregon estate tax. If you don't live in Oregon, but you own real property in Oregon, or you own tangible personal property in Oregon, you store your yacht in Oregon, your boat, your camper, then your estate is subject to Oregon estate tax. Here's the really nasty little surprise to many clients, is that it doesn't matter if you live in California and you own a beach house in Oregon and your Oregon property is only $500,000, but your other assets are $1 million, your estate is subject to Oregon estate tax because your total assets are in excess of $1 million. So you do a portion, basically it's a pro rata. This comes as a surprise to many, many people, okay? Washington has very similar laws. Washington's exclusion amount is $2,129,000. It's an odd number because it is subject to inflationary adjustments, so it'll increase as well, similar to the federal law. The Washington estate tax rates are 10 to 20%. I can't remember if Oregon's are 10 to 16%, so we have a little bit lower tax rate. But the same rules that apply to Oregon apply to Washington, in that if you are a Washington resident, all of your real property in Washington, your tangible property, and your intangible property are subject to Washington estate tax. If you're not a Washington resident, but you have Washington real property or Washington source tangible personal property located in Washington, you're subject to Washington estate tax. The Washington rule is that if your total estate is $2 million, then you're subject to Washington estate tax. So, but the same thing, we don't look at the value of your Washington property in determining if you're subject to Washington estate tax. We look at whether or not you're subject, what your total assets are. California, surprisingly, does not have an estate tax. So in the last 4 years, I've advised 5 of my clients who spend half their time in California and the other half either in Washington or Oregon to become California residents so that they can avoid the state estate taxes. And in one case, we're saving her children $500,000 because she's changing her driver's license and her voting registration because of the number of the days she lives in California. Yeah, it's significant. It can be significant. So one of the issues that also comes up is, and especially for those of you, speaking to a crowd of real estate investors, how many of you have real estate that is held in an LLC? Yeah, the majority. And why do we tell you to put them in an LLC? For asset protection purposes. But it could have negative estate tax consequences for you by putting those properties in LLCs if you're in a multi-state jurisdiction. For example, I am an Oregon resident. I own real estate in California. When I die, the real estate I own in California is not subject to Oregon estate taxes because I own it in my name or in my revocable trust. If I transfer ownership of the California property to an LLC, I have now converted that property from owning real property in California to owning intangible property, and it is now subject to Oregon estate taxes. If your property in California is of significant value, which most property in California is, that could have a significant impact on your estate. Another option, and this came up recently for a client who's an Oregon resident. He was doing a 1031 exchange and purchasing commercial property in Washington. And he came in and said, can we put this into an LLC? So we looked at what the impact was on that, because if we left it as Washington property owned by his trust, he'd be subject to Washington estate tax for that property, and he'd be subject to Oregon taxes on his Oregon property. If we put the Washington property into an LLC, we then eliminate the Washington estate taxes, but we pull that property into his Oregon estate for estate tax purposes. In his case, what we did, and this is basically all we can do, is did the estate tax calculations to figure out how much it would be in both scenarios. And for him, it was a de minimis amount in the difference because of the rates. And so it made sense for him to put the properties into an LLC to get the liability protection. I'm not saying don't put your properties into an LLC. I'm telling you it's a factor to consider if you're doing multi-state transactions, to consider the estate tax consequences. You may be far better to have the liability protection than save $100,000 in estate taxes when you're dead. And with that, I think my time is up. I'll be around if anybody has questions or would like to talk about anything further. Thanks.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.